On the 22nd and 23rd of July 2026, the Governing Council of the European Central Bank sits down in Frankfurt to decide something that sounds, on paper, extremely narrow, whether to leave one number where it is or move it a quarter of a point. Here's the thing. That one number is the interest rate for 21 different countries at once: Germany and Bulgaria, France and Ireland, economies that don't grow at the same speed, don't borrow the same way, and in Q1 of this year didn't even move in the same direction. Footnote 2. The European Central Bank raised that number for the first time in almost 3 years this June, to 2.25%, because energy prices tied to the war in the Middle East pushed inflation to its highest level in nearly 3 years. Footnote 3. Markets currently expect them to leave it alone on July 23rd, and hike again in September. Footnote 4. 1 rate. 21 economies. Every 6 weeks, whether it fits or not. Here is what the European Central Bank's key policy rate technically, mechanically is: the deposit facility rate, the overnight rate the ECB pays commercial banks for parking their spare cash with it. Move that one number and it ripples through mortgage rates, business lending and government borrowing costs across every country that uses the euro simultaneously by design. Footnote 5. It is set once, in Frankfurt, by the Governing Council, the ECB 6-member executive board plus the governors of all 21 national central banks, 1 seat per country, 1 vote each, deciding a single number that then applies uniformly the moment the meeting ends. Footnote 6. Here is what it is not: a rate tailored to any single one of those 21 economies. It cannot be. That is not an oversight. It is the entire design. In 1961, the economist Robert Mundell laid out the conditions under which a group of countries could share one currency and one interest rate without the arrangement eventually causing more damage than it prevents. Footnote 7. Workers would need to move freely to wherever the jobs were. Wages and prices would need room to flex. There would need to be some mechanism, a shared budget, a transfer system, to cushion a country having a bad year while its neighbors are having a good one. And ideally, the member economies' business cycles would already move roughly together, so one interest rate would rarely be badly wrong for more than 1 or 2 of them at a time. The Eurozone, when it launched in 1999 and every time it has expanded since, has satisfied some of those conditions and conspicuously not others. Labor mobility exists on paper and is blunted in practice by language and licensing barriers. Fiscal transfers between member states remain politically radioactive. This series will come back to exactly why in Section 3. And business cycles, as Section 2 is about to show you, are not currently moving together at all. Name the number, then name what it doesn't measure. 2.25% tells you what it costs a bank to borrow overnight from the ECB. It tells you nothing about whether the economy on the other end of that rate is overheating or barely breathing. Here is the important point about the global/comparative layer. Eurozone GDP contracted 0.2% in the first quarter of 2026, the first outright contraction since the end of 2022, and the sharpest quarterly decline since the pandemic. Footnote 8. That headline number is doing a lot of work to hide what's actually happening underneath it. Germany, the Eurozone's traditional growth engine, the country whose economic weight has historically set the tone for what Eurozone growth even means, expanded by just 0.3%. Italy, the Eurozone's long-running symbol of structural stagnation, also grew 0.3%. Identical. France didn't grow at all, it contracted 0.1%. Spain, the country that spent the 2010s as a poster child for austerity's damage, posted the strongest growth in the bloc at 0.6%. Footnote 9. The old story, a disciplined, fast-growing north and a struggling south, isn't just outdated here. It's been scrambled almost exactly backward. And then there's Ireland, whose GDP figure for the quarter swung by more than -12% in one direction depending on which revision you're reading. A distortion this series has already spent an episode explaining is mostly an artifact of multinational balance sheet relocation, not a real measure of Irish economic life. Footnote 10. One interest rate now has to be simultaneously appropriate for an economy whose official growth statistics can move double digits in a quarter for reasons that have nothing to do with Irish households, and for Bulgaria, which joined this currency union on January 1st of this year, still meaningfully poorer per capita than the Eurozone average it just signed up to share a rate with. Footnote 11. Here's the human scale version. A homeowner with a variable rate mortgage in Spain or Portugal, where floating rate lending is the norm, feels a rate hike in their monthly payment within weeks. A homeowner in Germany or France, where long-term fixed-rate mortgages dominate, barely feels it at all until they need to refinance years later. Footnote 12. Same interest rate decision, made on the same Thursday afternoon in Frankfurt, transmitted through the same 21-country monetary union, and it lands on households at completely different speeds, in completely different amounts, for no better reason than what kind of mortgage happened to be standard in the country they live in. The Bank of England, next door and outside the system entirely, held its own rate at 3.75% the same week. A reminder of what a central bank managing one economy with its own currency actually gets to do that the ECB structurally cannot. Footnote 13. So here is the most common question I can think of: why is this not getting fixed? 4 fixes get proposed every time this tension resurfaces. None of them survive contact with Eurozone politics. A genuine fiscal union, shared Eurozone-wide debt, a real transfer budget that sends money from strong economies to weak ones automatically, the way federal spending flows between U.S. states, would solve the mismatch directly. It has been proposed in some form for over 2 decades. Germany has rejected the core of it every time, because a transfer union means German taxpayers permanently subsidizing other countries' downturns, and no German government has survived selling that to its own electorate. Footnote 14. A country leaving the euro entirely and reclaiming its own interest rate is legally undefined. There is no exit clause in the treaties, and the closest real-world test case, Greece's flirtation with Grexit in 2015, showed just how catastrophic the mechanics of unwinding a currency union actually are. Footnote 15. The ECB's own transmission protection instrument, created in 2022 specifically to stop bond markets from punishing individual member states disproportionately, has never actually been used, and its activation conditions are political enough that nobody is confident it would survive a real test. Footnote 16. And national governments compensating with their own fiscal policy, spending more in a downturn, less in a boom, runs straight into the EU's Stability and Growth Pact debt and deficit limits. The same rulebook episode 6 already showed you constrains crisis hit governments even when the math says they need room to spend. Footnote 17. Every door has a locked room behind it, but this one was never hiding an incumbent's interest, and it isn't a mirror either. It's a founding bargain. Monetary union without fiscal union wasn't an oversight the Eurozone's architects forgot to fix. It was the specific price required to get Germany to join a shared currency at all in the 1990s. No permanent transfer union, full stop, and unsigning that bargain now requires unanimous agreement among 21 sovereign governments, several of whom joined specifically because the deal on offer didn't include open-ended fiscal transfers. So, here is the geopolitical current that seems to be more of an undertow. This is where episode 8 comes back into the picture. This series has already shown you the world quietly building alternatives to dollar dependence. Enbridge, CIPS, central banks stacking gold instead of treasuries. Footnote 18. The euro is the single most obvious dollar alternative on paper, a currency backed by one of the world's largest economic blocs, with deep capital markets and a genuine claim to reserve status. It currently holds roughly a fifth of global official reserves, a distant second to the dollar, and not gaining meaningfully on it. Footnote 19. Here's why. A reserve currency asks the world to trust that the institution behind it can hold steady under pressure. Every quarter this series just walked you through, a growth engine and a stagnant economy posting identical numbers, a member state statistic swinging double digits for reasons unrelated to its real economy, a newest member joining still catching up to the rest, is a quarter where that trust gets a little harder to extend. The countries actively diversifying away from the dollar have, so far, mostly diversified toward gold and toward each other's currencies, not toward the euro. Also footnote 19. That is not an accident of preference. It's a read on exactly the structural fragility this episode just spent 4 sections inside of. The ECB's Tightrope isn't just a European story. It's a live test of whether a currency union that cannot solve its own internal contradiction gets to be the world's answer to a different one. The tightrope isn't a metaphor for difficulty. It's a description of the mechanism. One number, 21 economies, no net underneath it if the number is wrong for enough of them at once. The ECB isn't failing at its job. It is doing, competently, the only job a single interest rate for 21 different economies can do, which is being right for some of them and wrong for the rest, every 6 weeks by design. Next, this series turns to the reckoning nobody sets a policy rate for. The slow one, decades in the making, that doesn't arrive with a Thursday afternoon press conference. Aging populations, shrinking workforces, and a bill that doesn't care what the governing council decides.